Hey everyone, welcome back to our channel, where we simplify financial concepts to help you make better investment decisions. In today's video, we're going to dive into a fundamental concept in investing: asset classes. Understanding asset classes is key to building a diversified portfolio that balances risk and reward. So let's break it down. An asset class is essentially a group of investments that share similar characteristics and behave similarly in the marketplace. For example, stocks from companies like IBM, Microsoft, and Apple are all part of the same asset class, equities. The key reason why asset classes are important is that different asset classes react differently to market conditions. That's why financial advisors emphasize asset classes when creating an investment strategy designed to minimize risk. There are four main types of asset classes that are often referenced in the world of investing: equities, stocks. When you buy equities, you're purchasing ownership in a company. These investments offer the potential for high returns but also come with more risk. Share prices fluctuate daily, and the success of your investment depends on the company's performance. You can make money either through dividends, a portion of the company's profits, or by selling your shares at a higher price than what you paid. Fixed income, bonds. Fixed income investments, like bonds, are essentially loans you give to governments or corporations. In return, you receive regular interest payments, and at the bond's maturity date, your initial investment is returned to you. Bonds are generally considered less risky than stocks, but they also tend to provide lower returns. The risk level depends on the issuer's creditworthiness. For example, U.S. government bonds are very low risk, while corporate bonds might carry more risk depending on the company. Cash and cash equivalents. These are the safest investments but offer the lowest returns. Examples include savings accounts, treasury bills, T-bills, and money market funds. Cash equivalents are highly liquid, meaning they can be easily converted into cash. This asset class is often used to protect capital in times of uncertainty but doesn't typically grow wealth over the long term. Commodities. Commodities include tangible goods like oil, gold, agricultural products, and metals. The value of commodities is influenced by supply and demand factors rather than the financial performance of a company. Commodities can be a good hedge against inflation because their prices tend to rise when inflation is high. So, why is it important to understand these asset classes? It's all about diversification. You've probably heard the saying, "Don't put all your eggs in one basket." The same applies to investing. By spreading your investments across different asset classes, you reduce the risk that one bad event will affect your entire portfolio. For example, when the stock market is down, bond prices may rise, balancing out your portfolio. Each asset class reacts differently to economic conditions, and their lack of correlation is what makes them so powerful when combined. By investing in a mix of asset classes, you can potentially achieve better risk-adjusted returns. Alternative asset classes. In addition to the main asset classes, there are also alternative investments that some investors use to further diversify their portfolios. These include real estate. Investing in properties can provide rental income and long-term appreciation. Real estate can be a great way to generate passive income. Cryptocurrencies. This is a relatively new asset class that includes digital currencies like Bitcoin and Ethereum. While cryptocurrencies have gained popularity, they are highly volatile and considered riskier than traditional assets. Collectibles. Items like artwork, stamps, and rare coins fall under this category. These investments are less liquid but can appreciate in value over time. Historical returns. Historically, equities have provided the highest returns over long periods of time. For example, the U.S. stock market has delivered an average annual return of around 6.7% since the 1920s when adjusted for inflation. In contrast, bonds and other fixed income investments have generally offered lower returns, but with less volatility. Let's put this into perspective. If you had invested $100 in the S&P 500 in 1928, that investment would be worth over $898,000 in today's dollars. Meanwhile, the same $100 invested in government bonds would have grown to only around $7,278 over the same period. This highlights the long-term growth potential of equities, although they come with more risk. Your investment strategy should be tailored to your financial goals, risk tolerance, and time horizon. If you're young and have a longer time horizon, you may want to focus on growth by investing more heavily in equities. On the other hand, if you're nearing retirement, you might prioritize preserving your wealth with safer investments like bonds or cash equivalents. Financial advisors often recommend combining asset classes that have varying risk levels and cash flow patterns to create a balanced portfolio. This helps you ride out market volatility while staying on track to meet your long-term goals. In summary, understanding asset classes is crucial for making informed investment decisions. By diversifying your portfolio across different asset classes like equities, fixed income, cash equivalents, and commodities, you can reduce risk and improve your chances of achieving positive returns. Remember, no single asset class is always the best performer, so it's important to have a mix that aligns with your investment goals. That's it for today's video. If you found this information helpful, don't forget to give us a thumbs up and subscribe for more financial tips and insights. Let us know in the comments below if you have any questions or topics you'd like us to cover in future videos. Thanks for watching, and happy investing!